So the question of buy term and invest the difference versus buying mutual whole life insurance is something that's been out there in the financial world for a long time. It was created, or this terminology was created a long time ago, essentially to, in my opinion, convince people to not buy whole life insurance and instead to invest more money. Companies like A.L. Williams had perpetuated this many years ago, and now companies like Primerica perpetuate this now. And financial entertainers, financial talking heads such as Dave Ramsey, for example, write about buying term and invest the difference. Here, for example, on Dave Ramsey, who is the number 2 or 3 talk radio personality in the country, says that to the question of, should someone buy this cash value life insurance? Well, the truth is that cash value life insurance is one of the worst financial products available. That is a pretty bold statement. And he goes on down here to say that if you follow the total money makeover plan, you will become self-insured. You will actually be self-insured, and you won't have to worry about having life insurance. So let's test this out, because that seems like a very two-dimensional approach. There's got to be more to this. So here's what we'll do. Let's take a look. Without any smoke and mirrors, let's just use a reputable life insurance company. Been around for, about 136 years. And we're going to use a 35-year-old male, healthy person. Just let's get an example of a comparison to the Dave Ramsey comments. So here's what we're going to do. Let's get through this. This life insurance illustration has a lot of information, but what we want to do is we want to get to this page here that has all of the numbers as far as the account values and death benefit and the cash values. And so what we're going to do is take a look at this page here to pull our values in. And so what you'll find here is this right here. So here on this page, you see that we have our 30-year timeline, and we have a 35-year-old male. And you'll see in this column here, I'll make it a bit larger, that right here, we're showing that we're going to put in this amount, this $10,345 for 10 years. And then from there on, for the remaining 20 years, we're going to look at a 30-year period of time, because the talking heads say if you just invest the difference somewhere else, you'll be better off. So let's compare the numbers. So here you see that this goes down for another 30 years, and at age 65, we stop putting money in because we're retired. Now, under the Dave Ramsey scenario, you will not only be retired, you'll be self-insured, and you will no longer need life insurance anymore. Your family will be completely without any need for life insurance because you'll have plenty of money. You won't need it. So let's test this out. What we're going to do is we're going to use a software program from a company called Truth Concepts. Todd Langford is the creator of Truth Concepts, and you can learn more about their company at truthconcepts.com. And Todd and his team have done some fantastic things with analysis tools that allow us to analyze these questions. So here's what we're going to do. We're going to take the data from this life insurance illustration, and we're going to plug it right into this analysis calculator. So here's what we're going to do. We're going to go over here. Let's make this a little smaller so I can grab the data. And we're going to, first we'll delete all that highlighting stuff. And let's grab the data. Number one, we're going to grab all of these premium numbers here. And we're going to go right down there. Whoops, let's see. I want to grab the actual, there it is. and I want to grab and copy. These are the premiums, the contributions into this account. So we're going to copy those, and we're going to go drop them right in here. There's the premium. There they go. And so let's go back, and what we want next is we want to copy the actual cash value. So now this is important to understand. What does the cash value inside a life insurance policy represent? Well, what it represents is this is the amount of money that if you were to cancel the policy or request a cash out of all of the cash value, this is the amount of money that the insurance company would send back to you. It's your cash value. Okay, we plugged it in there. The death benefit is the last piece that we'll plug in because it is life insurance, so it does come with a death benefit. Okay, so there we go. We copy that, and we're back here, and we paste it in there. So there we have it. Okay, so let's take a look. Now let's take just one more thing before I forget. The cash value, yes, it is the amount that you get back, but you have to remember that you also, under a mutual whole life insurance company, you also receive dividends and interest on the money that you have inside your cash value account. So you receive dividends and interest, and the companies that we use, this one here in particular, has paid a dividend every year for 136 years. So you might call that a very consistent dividend. So this company here, and like several others, have been around for a very long time, and they have paid dividends for a very long time. So let's take a look. We'll get back here to this calculator. Let's see what we're talking about here. So in our cash value growth, over 30 years, our cash value account grows up to $330,000. Now, if we stop right there and just look at the internal rate of return necessary, the year-over-year internal rate of return necessary to equal $330,000, we would have a 4.64% internal rate of return. Now, some in the investment world might argue, well, that's not, that we can definitely get higher returns. That's a terrible investment. Others will say, Dave Ramsey will say that it's not a good investment. The reality is, though, there's more to the analysis than just simply internal rate of return, because what you have to first understand is that the growth that happens inside a properly designed life insurance policy, it's so important to understand that terminology, properly designed, they build strong cash value, and they are growing tax favored, and in fact offer tax-free withdrawals, tax favored growth that other investments don't necessarily have. And let's do some comparisons on that. So if we start adding all of the analysis factors that need to be considered, let's see what happens. So in order for another investment account to equal this life insurance policy 30 years from now, that alternate account would have to at least earn 4.64. That's what we would be led to believe first. But now we know that 4.64% does not exist nowadays on a consistent basis. You'd have to be out there in the investment world going after that kind of a return. Well, being in the investment world, you know there's going to be fees. So there are many articles out there nowadays in Forbes and Bloomberg. There's exposés that have been done on the news regarding 401ks and investments. So let's say that we have management fees at 1.5%. So 1.5% in our investment account. Now, in order for that account to equal the internal rate of return of this whole life insurance policy, notice at the bottom of the screen, that investment account would have to earn 6.23% every single year without ever missing a year. Okay? All right, that sounds possible. Maybe it could happen. But now, if you're earning that kind of a rate of return, we also have taxes to deal with. So if we've got income taxes on the earnings, and let's say that we're in a 30% top tax bracket, and that capital gains in our state here in California is 24% total, and 20% of our gains are coming from capital gains, well, now the numbers are very different. In order for that investment account to equal the tax-favored internal rate of return of this mutual whole life insurance policy, all they've got to do is earn 8.13% every single year, linear, without ever missing a year. That, of course, has never happened. But that's not the end of the story. The end of the story would be great for those in the Dave Ramsey and the financial entertainer camp if we stop there. We've already basically said that doesn't work. It's impossible. But we're missing one key component in the buy term and invest the difference. They suggest, of course, that you buy the term insurance. So if we're going to buy the term insurance, we have to include it. So term insurance on this 35-year-old would cost $965 per year for 30 years to give them the equivalent death benefit that they're going to have in this whole life insurance policy. And in order to do that, they have to spend, of course, the $965 every year, and then they have a lost opportunity cost on the $965. They have to spend that, and they never get that cash back. So now, in order to keep up with this life insurance policy on the right-hand side, all they've got to do in that investment scenario is earn 9.3% linear every year without ever missing a beat. That has never happened before. And then there's one huge hole in the buy term invest the difference scenario. So not only do we actually still have the cash value that belongs to this family forever, this is guaranteed money, they also have the death benefit. That death benefit is a tremendous legacy benefit, tax-free, to this family or a business. And watch what happens when we go back here to this illustration right here. Watch what happens to that death benefit after this particular client stops paying for the insurance. What happens to that death benefit? The death benefit continues to go up and up and up and up. And they're not putting any money in. The cash value continues to rise. The death benefit continues to rise. The buy term invest the difference option that is perpetuated by financial entertainers, financial advisors, and the like is one of the most damaging pieces of advice that I can think of in the financial community. And it's for all of these reasons. We hope that you share this with your friends, share this with your family, and please call if you have any questions.